In this video, we're going to discuss relatively briefly some of the most important ratios which your curriculum lists as belonging under the topic of ratios used in credit or corporate credit analysis. And as we discussed in the previous video on assessing corporate credit worthiness, those ratios belong to a couple of groups. We're going to specifically drill down and discuss three of those. Looking at profitability ratios, or profitability measures to be more exact. We'll look at those measures which illustrate a company's coverage when it comes to its ability to service debt payments or interest payments, and leverage, which is all about the relative reliance on debt funding. All of these ratios of extremely highly used by credit analysts, especially the last two. Profitability is, as you will appreciate, a very widely used measure, not necessarily just in the debt world. Now, let me state that all of these measures are not going to be non-IFRS measures or non-GAAP measures, as they are sometimes referred to, especially in America. So there is no single definition of these ratios that we're going to discuss here in the IFRS or other rules of accounting. Analysts may use or utilize their own variants of these ratios, which they find more useful. There will be adjustments made to these ratios, so don't get the impression that there is a single version. Although for the purposes of the exam, it's good to know the official version as mentioned in your books. Okay, let's move on to the most important metrics, most important ratios within each of the categories, starting with profitability. Well, as you will probably expect and appreciate, a lot of the profitability measurement when it comes to credit risk analysis is going to be centered around the notion of operating profit. It is, after all, operating profit from which we derive operating cash flows, and it's those operating cash flows that provide a company a way to service its debt. So EBIT margin is the ratio that's mentioned in your curriculum. This is naturally the relationship between earnings before interest and taxes. So before we move on to the financing segment or financial segment of the income statement and the tax consequences, divided by the revenue generated by the business. And of course, up here, instead of EBIT, you will often find EBITDA, which is obviously earnings before interest, taxes, depreciation and amortization, which gets us somewhat closer to a cash flow measure. Now, the next group, coverage ratios, slightly more tricky because you'll be these are somewhat less known. Once again, lots of different variants of how we measure coverage exist. However, one ratio which your curriculum focuses on here is the relationship of EBIT. So once again, earnings before interest and taxes, or simply operating income, operating profit, and the interest expense. Interest expense. So to what extent is interest expense covered by our earnings before interest and taxes? Obviously, EBIT is calculated before the deduction of interest expense, so this is, I guess, logically sensible to measure things this way. The ratio measures the degree to which operating income, that's EBIT, literally covers our interest payments or interest expenses. Payments are not always equal to expenses, but that's another thing, the accruals concept in financial reporting. Right, a couple of notes. Just like over here we said that EBIT may be changed to EBITDA. Well, once again, the same is true, or EBITDA if you wish to focus more on a cash flow based measure, or cash flow closer to cash flow measure, you would take out the depreciation and amortization expense, making the numerator of the fraction higher. So this will give you if you switch to the EBITDA measure, it will give you a more favorable coverage ratio. However, please appreciate that there is another adjustment you can make. You can switch to EBITDA. And this is, of course, earnings before interest, taxes, depreciation, and amortization, but also R, which is going to stand for rental expenses. Okay, rental expenses. Now, what's the idea behind this? Well, you see, rental expenses are typically associated with operating leases, or at least what under US GAAP is still called operating leases. In IFRS, we just have leases. Whenever you rent, for example, property, these days under IFRS, it's treated as a lease and accounted for on the balance sheet. However, if you've got rental expenses sitting over here, you may take them out, and then in the bottom of the fraction, in the denominator, you may also then adjust and add not just interest expenses, but operating lease payments, to see how much your operating profit, your operating income before rental expenses covers not only interest expenses but also operating lease payments, which are generally rental payments. It's a bit tricky these days with the changes that have happened in recent years to international financial reporting standards, but it's an adjustment that does make sense. You don't have to necessarily perform this. You won't have to perform and calculate these things. You just have to know about them and be able to say that a ratio like this belongs under the heading coverage. So the way this gets tested, at least in the end of chapter questions, is just match the ratio with the appropriate group of ratios, either profitability, coverage, or the third and final one, leverage. So look, the way to be able to match them is coverage measures the degree to which operating income or some variant of it covers debt-related payments, be they pure interest expense or interest expense plus principal payments, right? If you've got a ratio that's structured in this way, it will belong under the heading coverage. Leverage measures, as we said in a previous video, the relative extent to which a company relies on debt funding. And the most common one you're going to get here is debt to EBITDA. So generally, an expression for how much debt you've got in relation to how much income you periodically produced. This ratio is often used or often cited, often referenced in loan covenants. Okay, and if you breach the level of debt to EBITDA, if this becomes too high, if too high, it typically triggers certain actions from the loan provider, from the bank, but also triggers ratings changes potentially, because ratings agencies also look at the relationship of debt to EBITDA. Please appreciate that we may also have debt in relation to assets, or as a purely balance sheet focused leverage measure. But also, let me write this down, I did say it in the previous video, but this debt may also be in the denominator. It may not necessarily, it doesn't have to feature in the numerator. It may also feature in the denominator of the relevant fraction. And a good example of this is a ratio I discussed in the previous video, RCF in relation to net debt So here we've got a turnaround, but because debt, either net or just debt, features in this ratio, it's still going to belong to leverage, right? It's not a coverage ratio. Coverage ratios don't necessarily have debt in them. They've got interest expense or interest expense plus principal payments that are made over a course of 1 year typically. Here, if you've got debt as such featuring in the ratio, it's going to be one of those leverage ratios. And as I said in the previous video, RCF stands for retained cash flow in relation to net debt. And be careful, right, what you wish for. If net debt becomes excessively high, this ratio becomes quite low, or the outcome of it. So lower ratio signals higher leverage, which is a signal or a sign of deteriorating creditworthiness. On the other hand, if you've got the debt in the numerator, a higher ratio leads to higher leverage when it comes to this one. So you have to be mindful of where the debt element sits to assess what you really want from a corporate issuer.